day and welcome to the Galaxy Surfactants Limited Q1FY24 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the call, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Unat Tanshekar, Promoter and Managing Director. Thank you, and over to you, sir.
Thank you very much. Ladies and gentlemen, a very good afternoon and welcome to this first earnings call for the financial year 23-24. At the outset, before we delve on the quarterly performance, it is important to reflect on the long-term picture. Despite the volatility that we have witnessed in the past 40 months, our stakeholder relationships have not only strengthened but further firmed up our internal processes, capabilities, and competencies. I'm sure the experience garnered will hold us in good stead going ahead. Continuing with the long-term picture, it is also important for us to understand the market picture as on date and how it will influence the numbers not only in the current year but perhaps for the next few quarters. India has emerged as the bright spot globally. We believe the key drivers for sustained uptick in consumption are a stable macroeconomic environment supported by innovation and technological developments, backed by a buoyant market filled with emerging new players and traditional majors. Today, with all the above-mentioned factors thriving, the stars are aligned for sustained double-digit growth going ahead. Galaxy is not only positioned to capitalize on this, but also playing a significant role in enabling it. The last 40 months have seen global inflation clocking new heights, something that the developed markets have not witnessed for the past 4 decades. It has not only impacted the spending frequencies, but also led to change in spending patterns. Combined with the ill effects of a war, bulk of the spending today is towards food, energy, and basic amenities. While the picture was the same, even in the pre-COVID era, the percentage and absolute amounts have increased significantly, thus adversely impacting the disposable income available for luxuries and premium products. The combination of excess inventory, slowing demand due to changing spending patterns, along with the fears of recession and high inflation, have completely dented the buoyancy seen in 2021 in the other parts of the world. But like any other cycle, barring any macroeconomic shock, we do expect things to improve slowly but steadily going ahead. With inflation easing and countries in the European Union adapting to the new normal, we do believe the end is near and consumption will make a comeback from 2024. A volatile global backdrop impacts imports-dependent developing countries the most. Despite this time, it has been no different. The sudden depreciation of the Turkish lira from 11 at the start of 2022 to 27 as of today, equivalent to a 245% in 18 months, and that of the Egyptian pound from 15 to 31 during the same period, dented consumption significantly in these markets. While this is something that had happened previously in Egypt, but the difference this time was the fact that inflation was mainly food-driven. This impacted domestic consumption severely. Even with respect to Turkey, fears of an economic collapse resulted in significant cutbacks and migration, thus impacting overall consumption. While the situation continues to remain grim and volatile, adaptation is visible. Barring for any other macro shocks, we are seeing signs of recovery. With improvement in goods supplies and stability in currency, growth should make a comeback in the second half of 2023. Focusing on this quarter, this has been a relatively stable quarter for us. Progressive improvement of supply side factors, along with pickup in demand, ensured a healthy 7.4% volumes growth for this quarter. We are pleased to share that in Q1 FY24, volume growth stood at 7.4%. This has been possible due to the strong double-digit growth clocked by India. Barring any risks due to monsoon or crude, we see this momentum sustaining. Africa, Middle East and Turkey is slowly but steadily making a comeback. While volumes remain flat year on year, we do see signs of improvement going ahead, especially from H2 2023. This should further enable us to meet the guided volumes target of 6 to 8%. Inventory destocking continues in North America. Like Q4, this yet again has adversely impacted our specialty volumes. Having said that, we are pleased to share that despite the decline in North America, quarter-on-quarter specialty as well as rest of the world volumes have grown. This has been due to the slight recovery seen in Europe and growth clocked in Asia Pacific by our specialty care products. The slowdown in Africa, Middle East and Turkey and North America has impacted our subsidiaries' performance, which after 2 good years are now witnessing headwinds on account of demand. While challenges persist, we do believe H2 FY23-24 will be better than H1 FY23-24. While we have refrained from giving out any EBITDA per metric ton guidance, going by the current trend and visibility we have, we believe EBITDA per metric ton should be in the zone of 20,000 to 22,750 per metric ton for FY23-24. For now, volume growth remains the key prerogative. To conclude, ladies and gentlemen, Stephen Covey once said, "Where you are headed is more important than how fast you are going." This is extremely important in the current context, as given the volatile and uncertain backdrop, moving ahead steadily holds the key. While growth may be slowing globally, the steadiness imparted by our India business is ensuring the volume momentum sustains. We remain confident that the second half of FY23-24 will be better than the first half, and that the volatility seen in the last 40 months should give way to sustained consistency from 2024-25. Thank you, ladies and gentlemen. We are now opening the floor to questions. Thank you.
Thank you very much. We will now begin the question and answer session. Any participants present on the audio bridge who wish to ask questions may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Sanjesh Jain from ICICI Securities. Please go ahead.
Yeah, good afternoon, sir. Thanks for taking my question. First on this EBITDA per kg, what we look to achieve in FY24, which is close to 20 to 23 rupees per kg. In this quarter, we are at close to 21 rupees a kg, and in the second half, we expect AMAT to pick up, which will be dilutive from the EBITDA per kg perspective. We expect it to recover. What will lead this? Are we expecting even better recovery in the specialty than what AMAT can recover, and the mix can always work in our favor? Is that, or number two, are we looking a stronger offtake of specialty in India? Has that trend started in a way which is very visible and it's positively rubbing off us on the margin side?
Yes, Sanjesh. Nataraj here. Good morning.
Hi, sir. Good morning.
Yes, Sanjesh. So first, as Shekhar said in his opening note, that volume growth is the key prerogative. Now, the guidance that we have given in terms of 22 to 750 is essentially with a very clear listing that the volume growth estimate is one of 6 to 8%. And we do expect that from second half, your Americas should pick up better. That means my special ingredients volume should have an uptick. That's one of the key assumptions based on which we have given this particular guidance.
And on the India side, even there the specialty is picking up any materially than what we have seen?
India is majorly driven by performance surfactants. Okay, there is, but that will not significantly drive the EBITDA per metric ton to the higher end of the band that we indicated. Rest of the world, more so North America, has to come back quite, aggressively. And that said, Sanjesh, yes, there is also a premiumization at play in India, which we would desire that it continues and grows further. Yeah.
Got it. Second, on the AMAT situation, Turkey and Egypt, you rightly said the situation remains very fragile. Last time we have seen a quicker comeback, but this time it appears will be a difficult. How much time do you anticipate to reach an FY21 kind of a volume in this segment from where we have almost fallen more than 20% now? Do you think it will take couple of years to again cross that volume line?
Very interesting question, Sanjesh. I think we did see sudden green shoots emerging at the beginning of this quarter, but surprisingly we have seen a resurgence of inflation again in the last a week to 15 days. Okay, so it remains highly volatile, and as we said, the new resurgence is again on food inflation. So we would expect the consumers to balance their wallet more in terms of the basic amenities, basic necessities. So we would like to be optimistic and at the same time be on guard in terms of the ground situation, whatever is happening. So we will get more clearer picture, possibly maybe by the end of this quarter.
On the Egypt plant itself, are we looking now to diversify more aggressively out of Egypt and Turkey? Because if we see the history right from the day we started work there, it has been very volatile, very uncertain. Do we enter aggressively in the Latin market, in the nearby European market and more Africa market, and reduce the proportion of Egypt and Turkey, thereby keeping that geography at least stable?
No, you are right. I think we have certainly diversified our product portfolio there in Egypt in a very conscious way. And Egypt is much more diversified in terms of its portfolio compared to what it was a couple of years back.
And at what utilization rate are we running now, Egypt plant there?
Today we are approximately about 68 to 70%, approximately.
Okay, for next few years we don't need to do the capex there, right? So it should be very stable in terms of free cash flow generation.
Yeah.
Second, on the specialty side, how are we seeing the offtake of the mild surfactant in the export market and the blended preservatives which we are proprietarily making? How has been the trend on these two sides?
Yeah, so this has been impacted. We have seen that since the second quarter of last year, because there has been an hit in terms of the premium segment and prestige segment in which these materials find use. So that's why it's important that the current demand situation, the restocking in US turns around well, and then we do see that things would start picking up. So that's one of the reasons why you see that the specialty volumes have got impacted. If that had been very intact, I think things would have been pretty different. So that's what we want to turn around in terms of the market situation.
Of course, one thing that we have seen is that though there is a a very, very small decline year on year, but on quarter, there has been an improvement with respect to the specialty products, which is an encouraging sign.
Got it. I thought it's more seasonality because even last year we saw the same trend. On a sequential basis, generally Q2 tend to be better because of the summers in the developed market. It's more seasonal, or do you really see the underlying demand also improving?
No, we have to, I think, as you said, see, on the macro level, the discretionary products, which is what in bracket, which means the specialty ingredients, have been impacted. That is for a fact. So we have to see inflation moderating or going back to the pre-levels. That is one, so that particularly the majority of consumers are able to have certain discretionary income, coming into their wallet. Now that's going to be a very important shift that has to happen in these developed markets.
Got it. Last two questions from my side. One on the capex, 150 crore, which we intend to spend this year. Where will it go? What are we looking in terms of opportunity to invest? And number two, the food inflation has again started. Do you see risk to the fatty acid prices again there because of this food inflation?
So first thing on the capex, it will be a combination of what we'll be doing in India and Egypt, and also will be on both the legs of performance surfactants and special ingredients. So some of them are already in progress in terms of implementation. So that's been the case even the previous years. And as regards the food inflation, yes, food inflation certainly if it pushes up the vegetable oil prices, so it can lead to an increase in your fatty alcohol and fatty acid prices. So as of now, it seems to be a little bit tepid. But it's more supply-led, so in case you have supplies getting impacted because of weather conditions, things can be significantly higher. So yes, so we're keeping a close watch on the weather patterns now and the stocks of vegetable oils in Southeast Asia. So let's hope that things don't, the supply remains not much impacted.
Got it. Thanks for answering all my questions and best of luck for the coming quarters.
Thank you.
Thank you.
Thank you. The next question is from the line of Nilesh Guge from HDFC Securities. Please go ahead.
Yeah, good afternoon, sir.
Good afternoon.
My question is on the raw materials, sir. Sir, if I look at the raw material prices, the fatty alcohol prices have fallen almost by more than 45% YOY and continuously going down Q on Q as well. So have you passed on the benefit of those to your long-term customers, or still there's something left with you?
No, it's been passed on, as is always the case.
So no further correction as far as the raw material prices is concerned, or pass on remain left?
No, there'll always be, because it's not that you pass on everything within the same quarter. So there'll be some amount of spillover. That is always the case every year. So significant portion of it keeps getting passed on the same quarter. So there's nothing different this time.
Okay. So based on the volume, I know that you stopped giving volumes, but based on the comments in the opening remark and the presentation, if I back calculate the gross margins for this quarter should be in the range of 51 to 52 rupees per kg. So do you think it will remain at this level for FY24?
No, see, the EBITDA per metric ton has been about 21, close to 21,500 per metric ton this quarter. So I didn't get your number of 51 to 52. What was that? Gross margin. No, yeah. So I think we need to focus on the EBITDA per metric ton. So that's what we have also guided to 22 to 22,750 with a volume growth of 6 to 8%. I think that should be the number that we should stick to.
Yeah. Okay. And sir, my second question is on the local and niche player share. So that share is continuously going up. At the same time, your MNC share is coming down in revenue. So, and you mentioned that there is a slowdown in a developed nation. Do you think this year also the share of a local and niche player will be more compared to your MNC customers?
I think no, it will be typically always moves within a range. So I think in India, everyone seems to be doing well, so I don't see that as an issue. But yes, there will be minor share churn amongst them, okay, and that's why it's keep it in a range. So I don't see that as a key determinant.
But just correct me if I'm wrong, if your share of this local and niche player increases, the margins will be better, right?
Yeah, it should be, but depending on what sort of product portfolio that we work with them. So yes, so in a general way it should be, okay, but it differs between customer to customer.
Okay. Thanks, sir.
Thank you. The next question is from the line of Rohan Gupta from Nuvama. Please go ahead.
Yeah, hi, sir. Good morning and thanks for the opportunity. Sir, first question is on closely looking at how we are guiding roughly now 2,750 rupees kind of margins per ton, though probably not adequately available the volumes which we have stopped giving. But we have been guiding for last year roughly 6 to 8% kind of revenue growth and expecting EBITDA growth higher than that and bottom line growth even higher than that within the operating leverage. Now when we're talking about roughly even at the high range of 22,750 kind of margins per ton, that leads to roughly close to 7 to 8% decline compared to last year in terms of margins. So even if we achieve the highest number, probably the bottom line growth look like more like a flattish in the current environment. So are we just being slightly conservative, or the scenario actually has changed much faster or deteriorated much faster than what we have anticipated 3 months back?
No, Rohan, Natarajan, yeah. So we are not being conservative, so we've been very realistic. We have explained as to how North America and Europe have been impacted significantly with the specialty volumes. Okay, and we also know that something needs to come around. So as we are very clear that we need to grow our volumes at 6 to 8%, that is a key priority, and we need to have the EBITDA, absolute EBITDA, to be growing higher than our volume growth. That's very clear. But this guidance is to only ensure that we are able to give some sort of speak, because we've stopped giving the EBITDA per metric ton guidance for almost last 2 to 3 quarters. So we wanted to get back to that so that the market gets some clearer picture as to how we are thinking as to where directionally things are going to be.
So you are saying that still there will be growth at EBITDA levels,
yes,
and higher than the volume growth.
Yeah, that's from our this thing perspective, we are very clear. That's what we work towards. That's what we aim at. But then we only want the external situation also to be equally cooperative. With that in mind, yeah, we should be growing our EBITDA absolute, okay, higher than our volume growth. That's very clear.
Right. Sir, last time when we were talking about that, we have seen a significant destocking happening in markets like in US markets now, like Walmart and all. They are going more closely towards the inventory destocking that has impacted the volume. However, down trading was also taking place in some of the markets like Europe, where the consumption or consumers have been facing the inflation. So do we see right now the volume decline which has happened? I assume that the inventory destocking situation will be broadly over. So it is now the real consumption which is getting hit, or you see that the specialty volumes which are still weak in the current environment is more weaker because of the destocking is still taking place?
So see, the inventory destocking is something that is started progressively coming down. So we do expect, based on discussion with customers, that by September it should be fully through. The other aspect also is, as what Shekhar said during his opening address, that there has been this thing where the consumers have started moving more towards mass and prestige products. So for them to come back to consuming in a very robust manner the prestige products, is something we do hope that it starts happening from the second half. So we are eagerly awaiting that. Probably we'll have a better answer to this question when we meet next for our conference call for the next quarter results.
Right. After the last question from my side. So we have seen that the fatty alcohol prices have fallen to almost 1240 level, which is almost pre-COVID or closer to that level. From here, we may see some slight recovery, but do we see that the impact or the falling raw material prices, which would have led to benefiting the end consumer in terms of the falling end product prices, it is helping only the Indian markets to grow, or the Indian markets are overall growing irrespective of across the categories and specialty also, and in a surfactants industry markets as well.
So Rohan, if you have been, we've been looking at the commentary of all our customers in India, the big customers. So if you look at them, all of them are very clear that the lower commodity prices has enabled them to pass on the reduction. So in fact, you've seen all of them have increased the grammage. There are more bigger packs that are now into the market. So that's aiding our customers to be able to start getting their demand higher, and they kickstarting consumption by lowering prices, increasing grammage. Yes, but for anything very significantly impactful as far as supply side is concerned, we do hope that the situation continues and keeps sustaining sort of growth momentum that has been there over the last 3 to 4 months in India.
Okay, so that's it from my side. Thank you so much.
Thank you.
Thank you. We have the next question from the line of Rohit Nagraj from Centrum Broking Limited. Please go ahead.
Yeah, thanks for the opportunity. Just first, initially, clarification, any specific reasons for not providing the volume data for the quarter?
Oh yeah, so it's we have decided to make a change from this time because what we wanted to be giving, given the context in which we're talking, that directional inputs are more important because the specific numbers can be a little bit not appropriate. So we said we'll stick to this as moving forward as the way that we'll guide the market in terms of what we have grown in terms of volumes. We will report the overall volume growth specifically, but the individual numbers typically need to be given in a directional way so that we end up being consistent in the way we put it across.
Sure. No worries. First question is on India. So we have seen consistently high growth over the last few quarters. And given that earlier the inflation was also higher, the growth did not, subside. So is it related to some specific new product introductions that we have done? I mean, you just alluded that in terms of the customers, they have increased the grammage, etc. But from our side, it is through some new product introductions, or is it based on the market share gain that we have had? Thank you.
It's a combination of all this that you have said. So there have been some volume share gains that we have had. The other thing is in terms of the way there are some categories that we participate in have grown pretty much well from our customers' point of view, which has enabled us to participate much more into their franchise. Okay. And the other one is we've also seen some good traction in terms of the new product introductions that we have done in terms of specifically to the D2C brands, and also in some new introductions that we did. So it's a combination of all these, because what is important that as much as we try on all these fronts, the market also has to be cooperative, and India has been really cooperative in terms of the demand side. So that's good for us, and if this sustains, I think we will have the numbers getting sustained in terms of India volume growth.
Right, got it. Just second clarification again, slightly on the numbers. I mean, pardon me, I'm pressing again on this. So last year we did about 568 crores of EBITDA for the entire year. First quarter we have done 123 crores. So if I just deduct 568 minus 123, it's close to about 450 odd crores. Which signifies about 150 crores of absolute EBITDA in the next 3 quarters consistently. So how confident are we that maybe given that we have given the EBITDA per metric ton guidance, is there any possibility of the 6 to 8% volume growth probably getting higher, given that we have seen positive tractions across the geographies and India is continuously performing exceptionally well? Thank you.
Yeah. So, it's what I'm saying is that you're pretty much right in terms of what you've concluded. But yes, our aspirations are very, very confident. But we do hope that the external scenario starts cooperating pretty well. And we do have reasons to believe that the worst is behind us in terms of the developed markets. So let's keep our fingers crossed. That's important. But an internal mandate to our teams is very clear that we need to better our last year EBITDA numbers, and we need, as we focus in terms of ensuring that we grow very aggressively on our volumes. That's very clear. So the guidance that we are given is to ensure that we are able to give some clarity, to the market participants. But that doesn't limit us in terms of what we need to do.
Correct. Thanks a lot for that, and best of luck, sir.
Thank you. The next question is from the line of Vipraw Srivastava from InCred Capital. Please go ahead.
Yeah, good afternoon. So just one question I had. So for this quarter, if we look at the EBITDA margins, it's around 13.1%. And that has been the trend for last 2-3 quarters, around 14 to 13%. So as we have seen, the raw material prices have actually come down significantly for Galaxy. So going ahead, if prices go upwards, so do we expect that these margins might contract slightly to around 10-11%, which we have seen historically, or do we expect these margins to hold for the next 2 quarters?
In fact, I don't think we need to utter any guess there. That's the reason why we guide the market in terms of EBITDA per metric ton. Because the margin percentages can vary depending upon how the raw material prices go up and down. So that clearly is not indicative of the propensity of our business to deliver margins. So actually, EBITDA per metric ton is what needs to be looked at.
Okay, makes sense. Okay, fine. Just one more question. So regarding the US market, which you have told that you expect the numbers to improve from the second half of this FY. So, is it based on some discussions with the end clients? Will they be taking more orders post the second half, or is it just based on just a qualitative analysis based on your experience? I just want to understand the reason behind that.
It's a combination, the way some readings that we do of what is happening in the market, some commentary in terms of our customers in the US market, some amount of face-to-face discussions and meetings with our key customers there. No one gives you these things very clearly, but this is what we surmise. Our team who are on the front surmises, and they relay it back to us. So it's based on that, we have come to this particular expectation in the second half of this year.
Okay. Thank you. Thanks a lot. Thank you.
Thank you. The next question is from the line of Krishan Parwani from JM Financial. Please go ahead.
Yeah, hi. Thank you for the opportunity. Just one question from my side. So, based on the qualitative commentary that you have given in the presentation about the volume growth, so basis that the realization for your specialty products have jumped significantly in this quarter. So, what would be the reason for the same, if you could answer that?
So, can you repeat your question, please?
So my question is, your specialty care realization has jumped from 134 per kg in the last quarter to 193 per kg this quarter, roughly. So any particular reason? Because I think it had started normalizing from, let's say, 230 to almost like 134 in the last quarter.
No, it's a mixed impact. Okay, so you also see that the volumes are lower for specialty, and then the mix with North America volumes being low, the relation per kg will look higher, right? Because there's a denominator which is lower. Okay, so plus there is also a mix that is so leading to that.
Okay, fair enough. That's it. Thank you so much for the answer.
Thank you. Ladies and gentlemen, if you wish to ask a question, you may please press star and 1. The next question is from the line of Bobby J from Falcon. Please go ahead.
Hi, gentlemen. Just wanted to clarify, what do you really mean by, the consumers not spending enough? Because all the data that's coming out from the U.S. at least shows that the economy is robust. That's the reason the Fed is not even stopping interest rate increases. Unemployment is a very low level. People are spending. They're splurging on luxury products, actually, if you look at the sales of Louis Vuitton and all that. So your comments don't really reconcile with what's happening there.
Oh, yeah, you're right, Bobby. Because we also been grappling with this. But then we've been trying to find, as we read our customers' commentary, we're also looking at competitors' commentary there. And we're also looking at all the other chemical manufacturers there. And all of them seem to be reporting very, very low results. Okay, so we are trying to establish a correlation. If the entire US market is doing well, why is it only in our segment, we and our competitors there in the US, and all the other chemical players in the US don't seem to be performing very badly? So we are trying to get to some analysis there. We are not yet completed on this. So we are also having the same question in our mind.
Okay. And could you give some actual examples of the products that use your chemicals? For example, I know there are sunscreens and other face creams, right? But what are the brands specifically? Can you mention them?
Oh, it will be your high-end shower gels. It will be shower oils. It will be high.
No, what I mean is the actual brand, like Head and Shoulders, or what's the brand you're talking about here? The high-end brand.
There are a lot of them. We don't want to be talking about that because there's some confidentiality that we get into with our customers. So we don't want to be revealing that.
Because when you say high-end brands in shampoos or sunscreens, it's hard to think of any. Most of the brands in the US, unless they're ultra high-end.
I'll give you an indication, Bobby. I think you should look out for sulfate-free formulations. Okay.
Sulfate, what was that again?
Sulfate-free. Sulfate-free,
okay.
Okay. So you can look at preservative-free. You can look at anti-aging.
Right. Are your chemicals, they are used in sunscreens, correct? The specialty chemicals that you sell.
No, we don't. It's not. We don't have a big presence in sunscreen formulations.
So your presence is where in anti-aging creams or just facial creams in general for women?
Into shower gels, into shampoos, into toothpaste, into home care formulations, both cleansing as well as fabric enhancers, all of them.
Okay. I understand. So if you take shampoos, when you say high-end shampoos, how does that compare with Head and Shoulders from Procter & Gamble? Would it be, 50% higher price? Or I'm just trying to get a sense of what kind of products you're referring to when you say high-end.
Oh, yeah. So you look at sulfate-free, typically is high-end shampoo. For anything that is sulfate-free is high-end. So compared to Head and Shoulders, you can look at any sulfate-free. I think you'll find.
So it'll be at what price premium to Head and Shoulders?
And there are a whole lot of niche players in US who sell these shampoos at a much higher price compared to what you call as Head and Shoulders.
Okay. So you supply to those brands.
They're all small niche
players.
Okay? There are a lot of small niche players around the United States of America.
So those are the ones you're referring to when you say that your volumes aren't picking up. Is that correct?
No. See, even all the major players also have their own premium high-end sulfate-free formulations. So even that has not impacted. All the players have their presence in high-end prestige formulations. Whether it be a local niche brand or even bigger customers who have their own brands into that segment.
Right. So some brand like Dove or Head and Shoulders would be masstige for you, right? That wouldn't be premium.
Yeah. They would come under the category of masstige.
Correct.
Okay, so you're talking about like a 20-30% premium to these brands. Are the ones where you're saying slow offtake. Right, would that be correct?
Yeah. I mean, you would be surprised to know that there are certain brands in US which sell for something like $16 a bottle.
$16 a bottle.
Yeah.
Oh yeah. Okay. Well.
But they may have a very, very small presence. Okay. So this is what I'm saying just to give you an idea what we call extreme prestige or high premium, very high premium.
Well, yeah. I mean,
sorry to interrupt.
A business model.
Please rejoin the queue for follow-up questions. Participants, if you wish to ask a question, you may please press star and 1 at this time. The next question is from the line of Karan Gupta from Varanium Capital. Please go ahead.
Yeah, hi. Just a second.
Sir, you are audible. You may proceed with your question.
Yeah. Hi, thanks for the opportunity. Am I audible?
Yes, you are audible.
Yeah, so my first question is related to the raw material, fatty acid and fatty alcohol is, I think, the most important raw material for us. Any plan, any possibilities to back-end integration of this raw material, basically this extracts from soybean, palm oil? Any backward integration you are planning or thinking about this? Because this is raw material fluctuating in price very much, more than 50% from quarter to 121, I think, quarter.
But that's not going to change even if you backward integrate. So that's better managed by our strategic vendor partners. They're doing a pretty good job. And we really have vendor partners who really work for us, think for us, and support us well to ensure that we are able to manage it volatility better.
Okay. I mean, see, I just did some small research on this thing. So the extraction from palm oil or your soybean oil will get you this thing, fatty acids and fatty alcohol. So would you think you can manufacture this in-house?
For your information, the fatty alcohols and fatty acids, which are significant or relevant or important for the personal home care industry, largely come from palm kernel oil and coconut oil, which are the main contributors in terms of what we call the lauric carbon chain. Okay, the palm oil and soybean oil also contribute to certain fatty acids, but the large constituents of the fatty alcohols in the personal home care industry are from the lauric chains. That gives you a picture of what specific oils are consumed significantly for the home and personal care industry.
Okay.
And soybean oil and palm oil do not have the lauric chain. Okay.
Okay, so it's better to rely on the vendor. Okay, second is something related to the, maybe this question or the information may be confidential to you, but just on the broader view, if I take the one bottle of shampoo, so how much the contribution of our overall products or chemicals in that bottle? I mean, in any product, what is the contribution of? Just wanted to understand the significance of.
For your information, a bottle of shampoo, the contents will contain almost 75% water. Okay, the ingredients, our ingredients going into a shampoo bottle will constitute approximately anywhere from 18 to 22% or so. So 75% is constituted by water. Okay.
Okay. So 18 to 20% is our product.
Yes.
Yeah.
Okay, great. So in one product, let's say shampoo or your sunscreen or nail polish or any personal care or anything, we can include 2-3 chemicals or 4-5 chemicals just to increase the effectiveness of our product.
It can be anywhere from a simple shampoo could contain only 4 ingredients to a very complex formulation which could contain even as high as 15 to 20 ingredients.
15 to 20 ingredients.
Depending upon the claims, the benefits, etc.
Yes.
Yeah.
Okay. The last one, related to the specialty chemicals, how is it going? We have major products in this range and contributing approximately less than our performance surfactants. So the growth trajectory of this specialty chemicals, you just give the broader sense.
No, we didn't hear the question properly.
I think there's some disturbance in your...
Can you please repeat your question?
Yeah. So...
Please don't do it. I think so. Kindly don't.
I'm not in the speaker mode. It's just I think the environment of the office maybe not allowing me to better communicate. So the last question is related to the specialty chemicals. I can imagine performance surfactants as a product, but some of the specialty chemicals I'm not able to imagine. So just give the broader sense of the growth trajectory of this, because we have the major product range in this segment and contributing around 38%. So just trying to understand the growth trajectory of the specialty chemicals.
Yeah, so we have said this earlier. So our strategy is to grow both legs of the market, both the performance surfactants and special ingredients. And they will continue to be in this particular proportion only, 60 to 60, 40, 65, 35. Because the way the ingredients get formulated, I think they typically are in this proportion. So there is, and the specialty ingredients portfolio, the growth will majorly be driven by the developed market, because there are much more evolved consumers there, and they have got a clear demand with regard to these prestige products, in which our special ingredients go in a significant way. So that's what it's going to be. Hello?
So the current participant seems to have dropped from the queue. Ladies and gentlemen, if you wish to ask a question, you may please press star and 1. The next question is from the line of Rohit Mehra from SK Securities. Please go ahead.
Yeah, thanks for the opportunity. Just one question. What is the current capacity utilization? And secondly, what is the debt to equity ratio?
As of today, the capacity utilization is 68%, and our debt equity ratio is less than 0.15. Less than 0.15.
Okay. Thank you.
Thank you. As we have no further questions, I would now like to hand the conference over to the management for closing comments. Over to you, sir.
Thank you very much. Thank you, ladies and gentlemen. And I look forward to the next quarter. Thank you.
Thank you. On behalf of Galaxy Surfactants Limited, that concludes this conference. Thank you all for joining us. You may now disconnect your lines.
Yeah.